Welcome back to class. So we go on with our next section here, which is going to be health policy provisions, options, and riders. Very similar to what we talked about, life insurance, provisions, options, riders. So a lot of this information will be reviewed for those of you that are life students as well. This will be brand new for the health students. This section, there's a lot of questions. Okay, so we'll kind of make sure we understand these things, but provisions that are required to be in these policies by law, usually by state law, and these required mandatory provisions are there to benefit the insured. There's optional provisions that are built into the policy, and these optional provisions protect the insurance company or the insurer. And then we're talking about riders, things that you can add to the policy, make it better, generally require an additional premium for coverage. Okay? So we start on page 123, top of the page, uniform required provisions. The box at the top of the page, those are the state-required uniform mandatory provisions. There's 12 of them to be specific. We start with our first one there called entire contract clause changes. Probably a question on this. As I mentioned earlier in that last section, entire contract clause states the policy is the policy plus whatever's attached at time of policy issue. So the application is part of the policy and part of the contract in case something becomes contestable in court. Now, in order for the application to be admissible in court as part of the contract, the insurance company has to attach it at time of policy issue. So, it's very important that they do so, and generally they will. So when they send you a copy of your policy, the application, a copy of that is included there, because it has to be in order for it to be enforceable or allowed in court as admissible evidence. Now, also stated in that paragraph, policy cannot be changed without mutual consent of both parties. Okay, so we learned about that in much detail earlier. We have the next paragraph, time limit on certain defenses. Okay, so we have something we've already learned about in life insurance that's different in health insurance. Now, in life insurance, we talked about the incontestability clause, which stated after 2 years, the policy was totally incontestable, even for fraud. So we had that saying, liars pray for 2 years, then they're covered. Well, in health insurance, it's not called the incontestability period. It's called time limit on certain defenses. It's still 2 years. But health insurance is always contestable for fraud. So in health insurance, liars pray forever. Okay? If the insurance company ever figures out that you committed fraud, they could always, at that time, rescind the contract. So referred to as time limit on certain defenses in health insurance, incontestability clause in life insurance. Grace periods. Okay, well, what is a grace period? Well, what starts a grace period, I guess I should say. Here's the answer, your premium. Now, say my premium is due on 3/1. Okay, it's due on 3/1 and I don't pay it. Do I still have coverage? Yes. For how long? Well, depends on how long my grace premium is. Or my grace period is, I'm sorry. So, it's a certain number of days I have to get my premium in. So this is to prevent my policy from lapsing. Say I'm out of town, or maybe I just forget to pay it. Bill gets lost in the mail. Certain period of time I have to get my premium in where I still have coverage. Now, in health insurance, it's tied to how my premium is paid or my mode of payment. Now, back to life insurance, just as a short review there. Excuse me, we had 3 grace periods. You had to know how long they were. 28 days on industrial life, 30 days on any other type of life insurance, including annuities, and 31 days for group life insurance. Now, the 31 days is the only one that carried over to health insurance. So in health insurance, we have, again, 3 grace periods. They're tied to how you pay your premium, though. You pay your premium weekly, 7-day grace period. You pay your premium monthly, 10-day grace period. You pay your premium any other way, quarterly, semi-annually, annually, and group health insurance, 31-day grace period. Okay, so say I have a 10-day grace period, okay, and my premium that's due on March 1st is $500. I don't pay my premium. I have a claim on March 5th, and my claim is $1,000. How much of that claim will the insurance company pay? The full $1,000? Or will they subtract out the premium I should have paid? Now, first question, am I in my grace period? Well, if I pay my premium monthly, how long is my grace period? 10 days. So, forgot to pay my premium on the 1st of March, have a claim on the 5th, I'm within my grace period. So this claim's covered. What's the insurance company going to pay? My claim minus the overdue premium. So we subtract that off, what I should have paid, and they'll pay $500. Okay, so that's how it would work, a claim in the grace period. We have last paragraph on the page 123, reinstatement. Okay, reinstatement in health insurance. This is our policy has lapsed. So I forgot to pay my premium. I went throughout those 10 days. I didn't get my premium in. My policy lapses. Now I want it back. The insurance company has to allow me the right to apply for reinstatement. And in health insurance, here's basically how it works. Okay? So my policy lapses. I want to apply for reinstatement. I have to do two things. I have to pay them the premium plus interest. And number two, I have to go through underwriting. So my policy lapsed. Why do I want it back? Well, the premium was based on a younger age and health conditions I didn't have when I first bought it. So I want to get it back. Well, I have to pay the premium plus interest on the premiums that I haven't paid. Plus I have to go back through underwriting. I have to prove that I'm not sick. Because that's what the insurance company thinks. They think, hey, you let this policy lapse. Why do you want it back now? What, are you sick? Well, no, I'm not sick. I just want the old policy back. Well, if I do this, then they'll give me the old policy back. Now, in health insurance, there are some things that were different on reinstatement. And here's one of them. The insurance company has 45 days to tell me. This is from when I submit my application for reinstatement. The insurance company has 45 days maximum they can go to notify me. Are they going to reinstate me or not? Yes or no? If they don't tell me on the end of the 45th day, I am automatically reinstated. So they go into this on the top of page 124. And at the end of those 45 days, if that's when they reinstate me, I will have a short little 10-day probationary period. And this probationary period will start whenever they reinstate me. If I get reinstated on the health side, I'm always going to have a 10-day probationary period. This is for any sickness that occurs during those 10 days. Regardless of how long it lasts, will not be covered. Now, how about accidents, though? When will accidents be covered? Immediately. Remember, probationary periods, they only apply to sicknesses, not accidents. Okay, good. So top of page 124, that first paragraph, there's where they mention the 45 days. Second paragraph, that's where they talk about that little probationary period, the 10-day probationary period there. And then the third paragraph down goes over what's referred to as claims conditions. Okay, so this stuff is important. You will see it on your exam. And basically, this regulates the back and forth between the insured and the insurance company and settlement of a claim. So they refer to these things as claims conditions. Okay, so here's our example. We have a medical expense plan, and it's a reimbursement plan, which means, and say, well, that we had a $500 claim that's fully covered. What does this mean? Medical expense plan pays doctors' hospital bills, right? Reimbursement means we go to the doctor, we pay the doctor, and we submit our claim to the insurance company to get reimbursed for our loss. So, this is the back and forth we have to go through with the insurance company. Okay? First thing we have to do to start the claim is submit what's called notice of claim. Okay? So this is done by, well, let me get this out of the way here. This is done by the insured. Notice of claim, 20 days. Okay, I have 20 days to submit notice of claim. Now once I do that, the insurer has to give me claims forms. They have 15 days to do this. So the claims, notice of claim would be I call them and say, hey, I went to the doctor. Call my agent. Okay, that's notice of claim. From that point, the insurance company has 15 days to get me the claims forms that I need to fill out. So the my agent says, hey, you can go right onto our website, or I'll fax it through the claims forms, because you, as the insured, need to submit proof of loss. And I have 90 days to do this. So proof of loss is me submitting those filled out claims forms and possibly a copy of my bill if that's required. Proof of loss. Difference between notice of claim and proof of loss. Notice of claim is I had a claim. Proof of loss is proving that I had the claim. All right, so it's in the insurance company's ballpark. So the insurer has what's referred to, this is called time payment of claims. The insurance company has 60 days So say up to 60 days. If it's a valid claim, they really should pay it to me immediately. However, remember earlier when Scott was smoking crack and he got in the car accident? Well, remember they had to do an investigation. Well, this gives them 60 days to do that investigation. So I submit proof of loss. That's really, if it's a valid covered claim, they have to pay it to me immediately. However, they have up to 60 days to do an investigation. Now, let's say they do that investigation, and at the end of the 60 days, they decide not to pay my claim. They say, oh, well, Scott was smoking crack. It's excluded in the policy, so we're not going to cover it. Okay? Well, so we go to the insured. What right do I have? I can take what's called legal action. And this is suing. Now I have to wait 60 days. And I have up to a statute of limitations, which depends on your state. So you'll see that when you get to that law section of the course, which you'll need to study on your own out of the PDF portion of the course. But it's whatever the statute of limitations on the legal actions in your state would be. 2 years, some states, 3 years, some states. It just depends on your state. Could be 1 year. So back and forth, back and forth. They have up to 60 days to pay my claim, called time payment of claims. They don't, I have the right to sue, called legal action. Now, on your exam, you could have questions on the number of days. How many days a person has, the insurance company has to, or the insured has to submit proof of loss? 90 days. Okay. You might have a question on what mandatory provision allows the insured to sue if the insured does not pay the claim. It's referred to as legal actions, as you see there in that chart. So that chart at the bottom of the page is very important for your exam. Depending on the state you're taking your exam in, you could have up to 5 test questions, maybe at the least 2 test questions on this chart. So again, very important. We've got 20, 15, 90, 60, and then up to however many years in your state with the statute of limitations. Okay, we go on to the bottom, page 124. Now, well, before we do, I want to make this point clear, because you're wondering, well, I've never gone through this in real life. Why? Well, okay, you go to the doctor, you go to the hospital. If you have insurance, you don't go back and forth through with the insurance company, do you? The doctors and the hospitals do. This is how they get paid. So they have to go back and forth, and they want to see your insurance card right when you go in there. Now, also, before they treat you, you sign off on this form, which is called an assignment of benefits. Okay, assignment of benefits. Well, the assignment of benefits assigns my benefits under my insurance policy to the doctor or the hospital providing the treatment. And this is what allows the doctor and hospital to submit claims on my behalf to the insurance company to get paid. So this assignment of benefits is just a form, but it makes this an easier process, because me as the insured, I don't have to go back and forth through this. True, originally I did with the reimbursement plans, but now I just sign this form, and then the doctors have to deal with it. And believe me, it's a major pain for the doctors to go back and forth with the insurance companies on this. Geez, they might have to wait a year to collect on a claim. Okay, so, and they probably, a lot of times, the doctors have staff that work full-time just doing billings to the insurance companies to try and collect for the services they provide. Okay, so we go to the bottom, page 124, last paragraph, physical examinations and autopsies. When's the insurance company going to require you to do a physical exam? Well, yeah, we talked about underwriting, they'll require it, but disability income, remember disability income, if you're having a claim, you have to prove you're disabled. So how do you do that? You go to the insurance company's doctor, and they might require you to go back every 6 months. How can they do that? Well, it's right in this provision, physical examination. Okay. Now, back earlier, remember I was smoking crack, crashed my car, had an AD&D policy, and it wasn't covered. Why? Because losses sustained while you're under the influence of drugs or alcohol are excluded, right? How do they prove it? Autopsy. How are they allowed to do it? It's a provision in the policy, in this paragraph here, physical examination and autopsy. Okay, we go to the top of page 125. Change of beneficiary is just like we talked about with life insurance. There were 2 policies in health insurance that cover death, accidental death and dismemberment, and travel accident. And for both of those, I'm going to have a beneficiary, which they're listed as revocable beneficiaries, meaning we could change them at any time. So that's all that has to do with there. Top of page 125, uniform optional provisions. Okay, so the mandatory provisions, for the most part, protected the insured. Now we're going to get to the optional provisions, which, as we'll see a lot of times, protect the insurer from various situations. So we have that first one there, which is referred to as change of occupation. Where would this apply? Well, remember in that last section we talked about sometimes you will have occupational coverage under your health insurance policy. Now remember, I said earlier I had no workers' compensation insurance. And I had an individual disability income policy. And that individual disability income policy was written as occupational coverage, which means I was covered on and off the job. Now, in this situation where I'm covered on the job, my job is going to be a rating factor, correct? So we agree on that? So my job's going to be a rating factor. So what I do is going to be of major importance to the insurance company. Okay, so I buy this policy from you, and I am a librarian. Okay, I'm a librarian, and you say, well, hey, that's not too risky. So the premiums, yeah, you're covered on the job, but it's very low risk of becoming disabled, so we're not going to charge you too high of a premium. Well, what about this? I work at a high school. Well, maybe a little bit more risk, but still pretty low risk, right, being a librarian. So I buy this individual disability income policy from you, covers my loss of income if I become disabled. 6 months down the road, I come in to see it in my wheelchair and a full body cast. And I say, hey, I've got injured, I'm disabled, I'm here to turn in a claim. You say, well, geez, what happened, Scott? Did a bunch of books fall on you? Say, oh no, I couldn't take being a librarian anymore. It was too boring. So about 3 months ago, I quit doing that, and I became a race car driver. I changed my occupation. Now, keep in mind, I didn't call you and tell you that I did this. I just did it. Which one's higher risk, librarian or race car driver? Obviously, the race car driver. So, if I had told you, that was an increase in risk, therefore an increase in premium. But I didn't. So, remember when we talked in life insurance about misstatement of age, person lied about their age, what happened in my example of Dick Clark and Britney Spears in there. This works very similar to that. Okay? I changed my occupation and I didn't tell you. I became disabled. Am I still covered? Yes. What's the insurance company going to do? Reduce benefits to what I was paying based on this job. Would have purchased me in benefits had I told you about that increase in risk. So change of occupation works very similar to misstatement of age. So we see in there, it says in the second sentence, if you later change your occupation to one that is more hazardous without advising the producer or company, benefits will be reduced in the event of a claim. If you tell the company about the change, it will adjust your premium to the correct amount and your coverage will remain unchanged. Then we have misstatement of age, which is just like it worked about in life insurance. Misstatement of age, you lie and say that you're younger than you really are to get a lower premium. Your benefits will be reduced when they find out about that. Relations of earnings to insurance, very important provision here, so put a star by this. Relations of earnings to insurance states if you have duplicate coverage, your insurance policy will never pay more than your actual loss. So, here's how it works. We can relate it to disability income, because that's where you see it apply when we're talking about earnings. Okay, I've got an individual disability income policy that I purchased from insurance company A for $50,000. Now here's my earnings up here, $50,000. That's how much I make a year. I insure from insurance company A $50,000 of my earnings. I go out and buy a second policy from insurance company B, disability income, that insures $50,000 of my earnings. I have twice the amount of insurance that I need. Why did I do this? Because if I become disabled, I want to make twice what I was making when I was working. Can I do that? No. What's going to happen? Well, relations of earnings to insurance, which is going to be in all these policies, because remember, it protects the insurance company, states each one of these companies will pay proportionately. So this company here will pay 25. This company here will pay 25. Relations of earnings to insurance. So I have full coverage. It's just shared between the two companies. And also they'll refund the excess premium I was paying for the coverage that I didn't need. So this is going to be a major pain in the butt because I'm going to have a deductible under both plans, which may be different. Plus, they might pay at different times depending on the company. So I might have to wait a couple weeks from one, couple weeks from another, and they might not come in at the same time. So it kind of might be a stretch as far as paying my bills. Now, relations of earnings to insurance is also included in the policy to prevent malingering. You see that term in that paragraph there, malingering. Very strange word. What does malingering mean? Well, here's what it means. Okay, I become disabled, and I can no longer work, and I'm getting a replacement of my lost wages so I can still pay my bills. And I become addicted to the soap operas they show on television during the day. And beyond that, I enjoy drinking a beer with my breakfast. Since I don't have to work, I can do that every day. So that becomes my routine. And I don't want to get better from this disability because I don't want to go back to work. And there's no incentive for me to do so because I'm making the exact amount I was when I was working. That's malingering. There has to be some incentive for a person to get better from their disability. So a lot of times, in order to prevent malingering, a person's disability to malinger, they will not insure the full amount of a person's wages, maybe 70% as a maximum. So there is some gap there where there is an incentive to get better from this disability and get back to work and make up that gap in your loss of earnings. Okay, so we go on. Next provision, unpaid premiums. We talked about this earlier in the section indirectly, but we were talking about grace periods. Okay, I pay my premium weekly. How long is my grace period for health insurance? 7 days. 7 days. Okay, that's my grace period. Now, I said if you have a claim during your grace period, it's covered, but the insurance company will subtract from your claim the overdue premium. What allows them to do this is this provision right here, unpaid premiums it's called. Cancellation. Okay, now in life insurance, when we talked about cancellation, if you were to cancel your policy, you might get some money back, you might not, depending on the policy you get. Well, in health insurance, we prepay our premium. So, if the policy is to be canceled during the policy period, and we've prepaid the premium for that time period, we're going to get a refund. Depending on who cancels the policy determines what the refund of premium is called. Now, it's a refund of unearned premium. Okay? So, for example, we'll say that we have here, well, let's just say that we prepaid our premium for the year. We paid $1,200 annual premium for the year. 6 months in, the insurance company cancels us for whatever reason. Now, keep in mind, if it's a cancelable policy, which most health insurance policies are, either the insurance company or the insured can cancel at any time. So the insurance company cancels me 6 months in for whatever reason. Say they don't want to sell these policies in the state anymore, so they're pulling out of the market completely. Now they have to give me a refund, and in this case here it would be a $600 refund. So they refer to this as a pro-rate or pro-rata refund of unearned premium. No cancellation penalty. They just prorate what I prepaid, cut me a check, send me the check with the notice. We're canceling you. Here's a refund of your unearned premium. Now, if I cancel, which I can, the insured cancels. They call it a short rate refund of unearned premium. Here's why. From that pro rata, they subtract the cancellation penalty and send me a check. So they short me my money. So most important is to understand what they're called. Insurance company cancels me. There's no cancellation penalty. They give me a pro rata or pro rate refund of unearned premium. I cancel them, which I can do. I cancel the insurance company. They charge me a cancellation premium. Or a cancellation penalty, I should say. Cut that out, and they short me my refund. Short rate refund of unearned premium. Okay, and then the last paragraph says conformity with state statutes. Conformity with state statutes, since most of these companies sell and write in most all states, or a lot of companies sell in multi-states, and these laws vary from state to state as far as what provisions are required to be in. This paragraph is always in the policies, and it states that the policy will conform to the minimum requirements as required in the laws in the state they are sold in. So conformity with state statutes states that if it's non-conforming, that the provision in the policy will conform to the minimum requirements of the state that the policy is sold in. However, as we'll talk about, certain federal laws are going to be the same in the policies in every state since it's a federal law. We'll go on to page 126, top of the page, first paragraph of 126. Illegal occupations, intoxicants, and narcotics. So here's the exclusions. Any loss sustained while doing any of these things is going to be excluded, unless it says the drug is administered on the advice of a physician, like you're taking prescription drugs, maybe painkillers, as long as you're following the prescription that's stated on there. And then we have other general provisions, top of the page on page 126. Right to examine free look. Okay, this is the period of time you have your refund provision. Most policies, 10 days. Okay, so this refund provision starts either the date of hand delivery or the date of mailing. And remember, it's sent certified mail, so you have to sign off, so we make sure that it gets to you. But this is the only period of time you can return your policy and get a full refund of all premiums paid. And it's generally always has to be stated right on the first page of the policy, big, bold, capitalized letters. You have the right to return this policy within 10 days for most health insurance policies. 30 days for certain policies. Long-term care, Medicare supplements have a minimum 30-day required free look. Insuring clause. And the insuring clause is a paragraph in the policy that states the insurance company will provide coverage in return from the premium you pay. Also, in the last sentence in that paragraph, the insuring clause states the parties to the contract, the type of coverage being provided, the type of risks that are insured, and it's generally stated, policy periods and premium as well, stated on the first page of the policy. And then we have the consideration clause, which you might have a test question on for the exam. The insuring clause includes the consideration clause. And the consideration clause is the insurance company's agreement to provide coverage in return from the premium paid. Remember, we talked about consideration in the general insurance portion of the course. It's required in order for the policy to be a legal contract. Is it required to be equal? Answer, no. So usually it's unequal. It's not required to be equal. The applicant's consideration is the premium they pay, plus their answers on the application. The insurance companies promise to provide coverage as consideration in return. Renewability clauses, bottom of page 126. These things here you could have a number of questions on your exam, so you have to know them. But they have to do with, can my health insurance policy be canceled? Yes or no? Am I guaranteed that it will renew at the end of the policy period? And remember, health insurance, usually policy period's 1 year. So will it renew? Are there any conditions I have to satisfy in order for the insurance company to renew the policy? Now, keep this in mind. Most policies sold are cancelable. They can be canceled by either party at any time. Okay, so we have number one, non-cancelable policy is just the opposite. It cannot be canceled by the insurance company. Question, can the insured cancel a non-cancelable policy? Answer, yes. Okay, it's non-cancelable by the insurance company. All right, so we go on to the next paragraph, number two, guaranteed renewable. And for some reason they like to ask questions specifically related to this type of renewability feature. Guaranteed renewable policy usually is guaranteed renewable until a certain age. Maybe age 50 or 60 or 65, depending on the company. But you're guaranteed that the insurance company will renew the contract regardless. Okay? Now also, under guaranteed renewable, the insurance company cannot change rates unless done by class. So they cannot single you out individually for a rate change by class under guaranteed renewable. However, they could say all young females from age 32 to 35 are going to have a 10% increase. That's a rate change by class. That they can do. Okay, so that's number two. Top of page 127, number three, conditionally renewable. A conditionally renewable policy states that there are conditions for the insured to satisfy, such possibly as passing a physical exam. And they're specified right in the contract. And if I satisfy those conditions, the insurance company will renew me. Number four, optionally renewable is kind of up in the air. You're not really sure. It's the option of the insurance company to renew or not. 5, non-renewable is just a temporary policy, such as for 1 year. 6, cancelable. Policy be canceled at any time by either one of the parties, and then back if we prepaid our premium, we're going to get a refund If the insurance company cancels us, what type of refund is that called? Pro rata or pro rate. We cancel the insurance company, short rate refund. Remember, cancellation penalty. Okay, and then they have that little chart there at the bottom of the page. It says non-cancelable, cannot cancel or change coverage or rates for any reason during the life of the policy. Guaranteed renewable, promises to renew as long as the premiums are paid up to a certain age or date. Coverage cannot be changed, but rates can be changed by class only. And then cancelable says, can cancel the policy with 30 days advance written notice to the policyholder. And there we have the end of that section. So a short little section, but a lot of things that are highly testable on the exam, so you got to know that. So go ahead and print off the next section, which is going to be disability income. Read through that, and we'll go ahead and present that in the next video here. So I will see you there.